Did you know that 90% of millionaires build their wealth through long-term investing? Or that the average billionaire holds onto their investments for over 15 years? Most people think the rich get richer by making quick, flashy trades. But that's not the case. The truth is, they play a very different game, a slow, patient, and calculated one. In this video, we're going to reveal the real secrets behind how wealthy investors grow and keep their money. You'll learn why they don't chase trends, how they invest in things you can't even see, and the surprising ways they protect their wealth for future generations. If you've ever wondered how the rich turn time into their biggest asset, stick around. We'll dive into the exact strategies they use to stay ahead of the market while everyone else is busy trying to keep up. Let's get started. Chapter 1. The Patience Principle. Why time beats timing. Most people think making money in the market is all about timing, buying low and selling high at the perfect moment. But wealthy investors know that's a gamble. Instead, they understand that time is their biggest ally. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." And he's right. Take this example. The average annual return of the S&P 500 over the past 30 years is about 10%. But if you missed the best 10 days in the market, your return would drop to less than 6%. That's why rich investors don't worry about short-term market movements. They don't panic when stocks drop or get too excited when they rise. Instead, they focus on the long-term trend and let compound interest work its magic. The principle of compounding is simple but powerful. Albert Einstein even called it the eighth wonder of the world. If you invested $10,000 at an 8% return, it would grow to $46,610 in 20 years. The wealthy take this approach, patiently allowing their investments to grow year after year. They don't chase quick profits. Instead, they plant seeds and wait for them to grow. Chapter 2. Secret Playbook. Diversification done differently. When most people think of diversification, they think of spreading their money across lots of different assets to reduce risk. And while this is sound advice, wealthy investors take a different approach. They diversify, but with high conviction bets. Instead of investing in 100 different stocks, they focus on a smaller number of high-quality companies that they deeply believe in. Take Bill Gates as an example. Even though he's worth over $100 billion, he has a significant chunk of his wealth tied up in one company, Microsoft. While Gates certainly diversifies in other areas like real estate and charitable foundations, his concentrated bet on Microsoft shows his belief in its long-term success. In fact, studies have shown that overly diversified portfolios often underperform. A study by the Vanguard Group found that portfolios with 1530 stocks had similar risk levels to those with 500 stocks, but the smaller portfolios often performed better. This is because rich investors focus on quality over quantity. They invest in companies with strong business models, competitive advantages, and solid management teams. This strategy is all about conviction. The rich are not afraid to double down on companies they believe in. They do their homework, invest heavily, and then hold on for the long haul. Chapter 3. Hunting for moats. The wealthy's obsession with enduring businesses. One of the biggest secrets of the wealthy is their focus on investing in businesses with wide moats. A moat, in business terms, is a company's ability to maintain a competitive advantage and fend off rivals. This concept was popularized by Warren Buffett, who constantly looks for businesses with strong moats to protect their profits over time. A good example of a company with a wide moat is Apple. Its ecosystem of products, from iPhones to Macs, creates a strong customer loyalty, making it hard for competitors to lure away Apple users. As a result, Apple has consistently high profit margins and a strong market position. According to Morningstar, companies with wide moats tend to outperform the market by about 2% annually. That may not sound like much, but over time, it adds up significantly. Rich investors understand this, and they search for companies that dominate their industries, have strong brand loyalty, or control essential parts of their supply chain. This is what allows their investments to endure, even during market downturns. When competitors struggle, companies with moats continue to thrive. That's why wealthy investors don't just invest in any business. They're selective, only picking those with the best chance of dominating their markets for decades. If you're finding this information helpful, Don't forget to subscribe for more insights on wealth building strategies. Chapter 4. Beyond Stocks. How the rich invest in intangibles. When most people think about investing, they think of stocks, real estate, or maybe bonds. But wealthy investors go further. They invest in intangibles. These are things like knowledge, relationships, and influence. They understand that these can generate long-term returns, often in ways that aren't immediately visible. Take Warren Buffett again. One of his famous quotes is, "The best investment you can make is in yourself." He's talking about lifelong learning. Rich investors don't just rely on their money to grow. They focus on growing their knowledge, constantly reading, learning, and improving their decision-making skills. According to a 2019 report by Credit Suisse, 47% of millionaires have postgraduate degrees, highlighting their commitment to education. But the wealthy also invest in networks. They know that who you know can often be as important as what you know. A strong network can open doors to investment opportunities that aren't available to the average person. For example, early investments in companies like Uber and Airbnb were offered to well-connected investors long before they went public. This is the kind of access that connections can provide. The rich also invest in influence. They understand that having a platform or a voice in their industry can translate into financial gain. Whether it's building a personal brand or gaining political influence, these intangibles can create opportunities for wealth that aren't directly tied to traditional assets. Chapter 5. The Art of Doing Nothing. Why smart investors don't chase trends in the world of investing. Sometimes the smartest move is doing nothing. This is especially true for wealthy investors, who are often masters of patience. They don't chase the latest market trends or jump on every hot stock tip. Instead, they stay the course, confident in their long-term strategy. John Bogle, the founder of Vanguard, once said, "Time is your friend, impulse is your enemy." He was referring to the fact that chasing trends and constantly tinkering with your portfolio can hurt long-term returns. In fact, a study by Dalbar found that the average investor underperforms the market by nearly 4% annually because of poor timing decisions, mostly from trying to react to short-term market movements. The rich understand that chasing trends is risky. They don't care about the latest cryptocurrency craze or the hottest tech stock of the moment. Instead, they focus on businesses and investments with proven track records. This is why so many of them hold blue-chip stocks. Companies like Johnson & Johnson or Coca-Cola that have been around for decades and are likely to be around for many more. This strategy is about resisting the urge to do something just because the market moves. The wealthy know that sometimes, the best course of action is to wait and let time do the heavy lifting. Chapter 6. Legacy Building. Wealth Transfer Through Generational Investments. Wealthy investors don't just think about their own lifetimes, they think in terms of generations. One of the key strategies they use to build and preserve wealth is planning for a smooth transfer to their heirs. This long-term thinking ensures their investments not only benefit them but also their children and grandchildren. According to a study by UBS, 91% of wealthy investors feel it's important to leave a financial legacy. But they don't just hand over money. They create structures like trusts to protect their wealth and pass it down efficiently. Trusts, for example, allow them to control how and when their wealth is distributed, often shielding it from taxes and creditors. One famous example is the Walton family, the heirs of Walmart. The family's fortune, estimated at over $200 billion, is managed through a series of trusts and family foundations. These structures help maintain control of the company and keep the wealth growing for future generations. But it's not just about protecting money. Wealthy investors also focus on teaching financial literacy to their children. They want the next generation to understand how to manage and grow the family fortune. This kind of education is an intangible investment that ensures the wealth isn't squandered. This long-term planning also means avoiding risky investments that could jeopardize the family's future. Wealthy investors tend to be more conservative with money earmarked for future generations, focusing on preserving wealth over aggressive growth. As Warren Buffett said, rule number 1, never lose money. Rule number 2, never forget rule number 1. This cautious approach ensures their wealth lasts for generations. If you enjoyed this video, please subscribe for more insights and tips on building wealth and securing your financial future.